Hey, welcome back, everyone. So, we're going to be taking a look today at an unprofitable company. Kind of a not a normal thing on this channel if you've watched any of my other stuff. But yeah, we're going to be taking a look at Voyager Digital. Now, this is a stock that has really taken quite a spanking in recency and dropped like over another 20% today due to essentially a cease and desist being put out on them. So I'll quickly kind of clear the air on that and say, in my personal opinion, first of all, cease and desist because of their staking that they do on the company, because they do make revenue off of staking people's money. This was only from like 4 states. That's my understanding. 4 states within the US. We have 52 states. That's not going to really affect them in any way dramatically. Not enough for you to think that the company, or the stock at least at the time, is worth close to 7 and then it drops to like 5. So over 20% drop. Not justified. That's not anything new in the stock market when you see something drop quite dramatically, to be honest. A lot of the time these big sell-offs aren't really all that justified. But anyways, I want to get back to this and just kind of look at some stuff when it comes to Voyager Digital. Why am I even looking at a stock like this? I normally only look at companies where I can really do a strong, valuation, look at the fundamentals of the company and, have years and years of numbers to go on and metrics so that I can make a proper valuation on the company, so that I can project my favorite way of valuing a company, projecting future free cash flows and discounting them back to get a value for the company today. Obviously, that's not really something you can do with Voyager Digital, so that's not what we're looking at with this company. But what I am looking at is the fact that when a company becomes theoretically, because again, it's hard to value a company that's unprofitable, these growth type companies like this that are unprofitable, it's very hard to value them. But in my mind, when a company potentially becomes so cheap it's hard to ignore, it makes me raise an eyebrow. Okay, so join me on the screen here. We're going to go ahead and take a look at the company, and their previous close was 670. They had opened at 645 just the other day here, and they had went as low as I think like $5.06 or something like that. It's at 516. Who knows if it goes below 5 come Monday, where's my brain? Come Thursday here, because I'm recording late at night, so who knows yet. The first thing I noticed, especially after this drop, is wow, their price to sales ratio is really low. And let's actually go to let's go there on the screen. I believe that would be on Yahoo Finance. That would be in the statistics. Okay, there we go. Loaded. Yeehaw. You've got a price to sales ratio of 2.5. Now, for anyone who's not really too familiar with looking at price to sales ratio, it's one of the best metrics you can use to start kind of looking at an unprofitable growth company like this and get an idea of, is it starting to enter fair territory? Something where it's actually not overvalued anymore. To put this into perspective, a lot of, high growth companies that have a lot of hype behind it and, high growth, but they're unprofitable, they sometimes trade as high as like a 30 times price to sales ratio, which that's a company I don't care if it's the next sliced bread, I will not touch that. An unprofitable company starts to at least catch my eye, where I start keeping an eye on it once we enter about a price to sales ratio of 6 or under. Now, real quick, price to sales ratio is just your market cap, basically, of the company currently divided by revenue. So in this case, we'd be looking at trailing 12 months revenue. So yeah, again, you normally, once you enter 6, that's when you start to look at it like, okay, maybe this isn't bad, because if they can reach profitability at some point here, where I can see where the profitability is going. And I'm like, I like the course it's taking, and growth still stays very high. Then with high growth, you can justify a higher price to sales ratio, a higher PE ratio, different metrics like that. We got high growth, still unprofitable, but you enter 6 or under as a price to sales. Well, this is currently at 2.5. But let's look back to the screen. That's actually a lie. I just felt like saying what Yahoo had posted because they have the market cap labeled at about 1.14 billion. A lot of finance type websites or whatever don't update their metrics enough, as much as you would think they would be. So if we take a look at this, it's not really 1.14 billion in market cap that we have. Last kind of more updated market cap is more closer to 884 million for a market cap. If we want to take 884 million divided by their trailing 12 months revenue of 415 million, 884 divided by 415, you get a price to sales ratio of more like 2.13. So very, very close to 2. That's a price to sales ratio that really does intrigue me quite a bit for a high growth company like this that is not profitable yet, but is expected to reach profitability and a positive EPS overall for the whole year by the year 2023. Well, in terms of a horizon, that's really not that far away. If you're showing me high double-digit growth like that with a price to sales ratio currently at basically 2, it definitely makes you start to look. And the EPS estimates, it was still in the negative for year 2022, but by 2023, they were expecting on average like 41 cents EPS. I mean, that's really good. Basically, if that holds true and it is like 41 cents, give or take, it always can be a little different. That's the average estimate. But if it's, let's just call it 41 cents for 2023, they're finally gaining profitability. And the price to sales right now that you can buy it at is roughly 2, with revenue growth that is well over 30%, high double digits still. So without rambling on, what am I getting at here? For me, this isn't a break the bank investment. I've recognized that a company has been beaten down senselessly to almost a point where I'd argue it doesn't make sense, especially when revenues are continuing to climb, estimating and expecting profitability by 2023, which you really can't say for a lot of these high growth, unprofitable companies that they're going to be profitable by 2023. But to me, this stock is kind of in my gamble pile. Gambling, I call it gambling with insurance. So it's not a complete gamble because it's not like I'm investing into some ridiculous company with a price to sales ratio of like, 30, 40, 50, something I would never touch. It's a gambling type stock to me with some insurance. I don't have a lot of metrics in terms of stable profitability and stable free cash flow where I can value the company the way I like to value it. But, there's a few key metrics here, like a current price to sales ratio of basically about 2. Very high double-digit revenue growth expected in the future to continue on. 2022 is triple-digit growth expected. If you look on the screen here, we have a forward PE based on, expected numbers in the future of 12.89. I mean, that's a good PE. Especially with that sort of price to sales ratio and that sort of revenue growth. But again, to me, this is sort of in the gamble pile with insurance. I might make a small investment. I haven't yet, obviously, or I would be sad if I had invested the other day and it dropped over 20%. I'd probably be a little upset. I'm sure some people are. But, to me, this is in the gamble pile with insurance, Maybe throw, obviously, you're not going to invest in it like I invest on Google or other very stable companies that I can truly value. But maybe this is, something I throw $500 at or 1,000, whatever, a small investment. I treat this more as a trade, a short-term trade. If it does really well, I'm going to just capitalize on my trade and take the money out and, yeehaw, made a few $1,000s potentially. If it like, magically 3 or 4 X's. And if it goes down more, I didn't really lose a lot putting like, $500 in or whatever. And I'm okay gambling with insurance on stocks like this where they've been beaten senseless. And some fundamentals that I like to value an unprofitable high growth company with are starting to make sense, like high revenue still, expected profitability coming in the near term future, and a low price to sales ratio. Okay, so yeah, I mean that wraps this one up, I mean, what do you guys think about Voyager Digital? Personally, again, I'm not betting, I wouldn't bet a lot on this. I'm probably gonna throw, $500, maybe 1,000 at it. To me, it's a short-term play where you trade it if it goes up. If something changes in the future where I still hold the stock and something changes where I still want to hold it, because I think there's a lot of potential, that's fine. Now I have my investment. It's potentially gone up, and my initial investment was very low. So my risk for this is very low. It's all about risk tolerance. If you like what I'm saying or you already know about what I'm saying and you're willing to risk the whole bank on it, that's on you. To me, this is more of a gamble with a little insurance, and I'd make a very tiny investment in it. And if it shoots back up to $10-15, which is not unlike this stock to do, it's fun to look at that you made a 2, 3, maybe even 4x. And yeah, I mean that's gonna be it. I'm gonna leave off right there. Y'all have a great day.